Hey there, Steve Rubis with another installment of Capital Markets Investor Relations in 2 minutes or less. Today we're going to talk about the three types of short attacks. And if you're a management person at a public company, there's a lot of reputation, career, and compensation risk linked to a short attack. And a short attack is meant to drive a 50 to 90% decline in stock price. So it's destructive to your share price. So it's important to be familiar with the types of short attacks and if you can defend against them. So the first one is this idea of the structural flaw in the business as a short attack. This is the most powerful because it's based on an irrefutable premise. And secondly, the supporting data points do a good job of supporting that true statement, and it's meant to illustrate some sort of nefarious behavior by management. And those three things together drive that significant share price destruction. An example is if there's an accounting issue, or the one I like to use, which is I did my clinical trials in Latin America. I, as a management team, can't defend against that. And then the second short attack is this narrative-driven short attack, and it's very subjective. So you can actually defend against this. The investor may not like your business model, they may not like the way you're running your business or how you talk about your business. The supporting data points are probably very subjective and can be explained away by simple business judgment. And use your auditor hat here to defend against the narrative-driven short attack. And in my mind, the Adtalem Global Education short attack is one of these narrative-driven short attacks. And then finally, you have an earnings performance-driven short attack. These are very short-term in nature, probably a tactical call around the quarter. I think management teams get way too upset about these short calls because they don't realize that the only people who care are tactical hedge funds looking to make a quick buck on the quarter. The majority of investors are long-term and are going to give you a pass on that negative earnings result if you have a track record of several quarters, several years of beating and raising or managing financial expectations. The example for me is Cerner. When I had a sell call on Cerner, it was earnings driven. They missed earnings in the third quarter of 2015. No one cared because they had a track record of 60 straight quarters of beating and raising. Remember, you can defend a lot against a short attack if you have a good track record of managing financial expectations and executing on what you say you were going to do. With that, always here to help. Thanks for watching, and let me know if you need help with your capital markets, investor relations, or corporate finance needs.